This morning I want to take a look at cash flow, and the company I chose here to do is Sturm Ruger. I've looked at several. A lot of them, honestly, you're going to look at the cash flows and not find anything that stands out, and that's fine. Companies may or may not have a lot of different things going on in their cash flows. Even looking at Sturm Ruger, I looked at Nike a little bit earlier. They had some similar things kind of going on that I just want to talk about so that you guys can look at. Some of them you probably ought to talk about. There are things in the cash flow that are truly, let me just call them accounting things, that really don't have a ton of impact, and I'll kind of try to point those out as I'm going through it. Other things though that can really be reflective of what's maybe going on, or different things that are going on within a company, and worth looking at least kind of scanning. And in this case I didn't download it to Excel, and I surely could have, but I thought, well, I'll just come and we'll take a look here at some different things. So again, this is Sturm Ruger, and we'll just look at the last couple of years just to give you an idea. And there may be some stuff, and you guys should look at going back several years, because there may be some stuff going on. But I thought I'll just look at a couple of years here, really 2020 and 2021. So first, income and loss, and that's just your net profit, right, that the company makes, and how much that contributes. Of course, if that's positive, it should contribute positively to cash flow. Then we end up with all kinds of adjustments to cash that are below that. And one of the first ones, and often biggest, although several of your companies have little or no depreciation because they don't have a lot of physical assets. A lot of your tech companies anymore really don't have a lot of physical assets that they're going to be depreciating. Airlines, believe it or not, may not have a lot of physical assets. They might very well just lease the airplanes that they're using. Okay, and so you may or may not see a lot of depreciation. What would catch your attention here maybe is if there were some big changes. Okay, in this case there's no real big changes. It stayed about the same. It means they probably didn't add a ton of new fixed assets to their company, right? Okay, stock-based compensation, and what's that mean? Well, compensation is a deductible expense, right? So it show up that way on the income statement. But stock-based means that they just paid whoever, probably executives within the company, they paid them in stock. So they gave them just additional shares of stock in the company. So it didn't create a cash loss, and so they're kind of adjusting for that. Still an expense, right? But not a cash expense, kind of like depreciation's an expense, but not a cash expense. The taxes, not a huge number there, non-cash adjustment that might go on with the provisions that they've made and whatnot for taxes. I'm not 100% sure. I'd have to look that one up myself, but again, it's a small number. I'm not going to spend time doing that. And I'm going to kind of cruise down here. Gains, loss on disposals of other assets is what that means. Not a big deal. This is just the total adjustment for non-cash items. Again, it really hasn't changed a lot from year to year, so not really a big deal. Okay, that goes up. That's mainly your depreciation, right? Now this kind of catches my attention a little bit. It's not a huge thing, but change in inventories. Now, what you got to remember here is we're talking about the impact on cash, and so these kind of give you, if you think about them, it's kind of the opposite of what we're seeing, and let me explain. So in 2020, their change in inventories increased the cash. Well, what's that mean? That means that their inventories were actually reduced in 2020, and thus cash came in, right, to replace those inventories, and so it increased the cash. Okay. So on 2021, however, the opposite's happened, right? So what's happened? Well, they've increased their inventory substantially, okay? And thus that's taking cash out of their account, okay, because they've had to increase inventories. They've decided to increase inventories. We have the pandemic going on. That could be one of the reasons that inventories, there's a lot of money that got sent out in 2020, pandemic relief, whatever you want to call it, and there's a lot of demand otherwise, and part of that was a change in administration. Whenever you get somebody who's not maybe as supportive of firearms, there's always a rush of people to go out and buy firearms, and so that may have been why inventory is reduced. Okay, that's something on the cash flow that probably deserves taking a look at. And in 2021, maybe those things have modified, or maybe Ruger's just been able to pick up their manufacturing enough to try to replace some of those inventories. And I did note that at North 40 the other day, they actually have some ammunition in stock, primarily a whole lot of 9mm. Change in accounts receivable, and this is kind of similar to this, right? So if your accounts receivable in the cash flow here sheet, if the accounts receivable has gone down, or your cash has gone down as a result of accounts receivable, that means that your accounts receivable actually increased. So people were buying things and reducing your inventory, but in some cases they were doing that on account, right? So your accounts receivable grew, which has the effect of minimizing or eliminating your cash flow. Okay, and the opposites happened here a little bit, but not in a big way, right? So the accounts receivables actually decreased, but just modestly. Okay, and accounts payable, kind of the same thing. If your accounts payable, if your cash grew as a result of accounts payable, it means that you've delayed paying some of your suppliers. Okay, so your accounts payable grew. Now, these two seem to go together. The change in inventories and they were probably purchasing supplies and whatnot, or raw materials, okay, on account to some extent, in order to increase inventories. And so that's probably what happened in that case. Excuse me. Changes in tax payables, this is one of those that there's some accounting things. I don't get terribly concerned about that. Total change in trade and other payables is just a total of those things there, right? Changes in provisions, and provisions is another, I'm not going to call it a gimmicky thing, it's not, but it's probably an accounting thing that's not going to affect our analysis too much. In banking, banks have to set aside money as provisions for loan loss, for expected loan loss in the future, and so they have to set aside that money and show it. I would imagine in gun manufacturing it's maybe the same thing. They have to set aside and make provisions for potential recalls, those types of things that might happen in the future. And so those can have in 2020, maybe because they sold down inventory, right? Maybe they were able to take some of those provisions off, and now in 2021, they've added back to some of those provisions. Okay. Change in deferred assets and liabilities. These are generally tax things, tax assets or tax liabilities, and I tend to kind of ignore those for our analysis. Again, this oftentimes has to do with these provisions up here. They kind of go hand in hand sometimes. So, and that gets to be fairly complicated, maybe more complicated than even I want to dig into. I guess I have a couple of times, and it's a rabbit hole that you can get pretty deep into. So, change in other operating capital, other things that you might have, just kind of a catch-all category. Is this a big deal? Probably not. Okay, so total. Now, what's interesting is you get all the way down here, right? You got total cash generated from operating activities, and it just kind of, yeah, that's interesting. It's not, if you remember this, certainly for this year, not that much different. Okay, in 2020 they actually generated some more cash, probably because they had some, total changes in operating capital, some different things that were positives that are less positive, at least this year. Okay, so there's only a couple things, that I think the inventory and receivables up there in that part of it probably be of some concern, probably worth taking a look at. Maybe the payables. Okay, this is important down here, and in Ruger's case, there's maybe not a lot to see, but in some of yours, you may find some things to see that are really, really important. Purchase of property, plant, and equipment. It looks like, and this may be one case where maybe I should go back a little bit, right? kind of looks like they have a pretty steady program of purchasing property, plant, and equipment. Maybe they just have to replace some of their equipment, their manufacturing equipment, on a fairly regular basis. If you kind of average it out over the last 5-6 years, it looks like it's in that 20 to 25 million dollar range. Okay, up and down a little bit, but not a heck of a lot. So that just looks like a constant. I don't know that I'd be too concerned about that. Purchase of investments. This kind of looks like a big number. It is a big number, but it's really kind of almost meaningless in a sense. Companies often have excess cash, and what do you do with that excess cash that's kind of been sitting there? And they like to keep it, okay, but they don't like to just have it sitting in a checking account, because you and I know you don't get any little or no interest on a checking account. So they'll invest it generally in short-term government securities is generally the case. And so all this means, if you look at it, they purchased a bunch of securities, but guess what? They sold off about the same amount, and they did roughly the same this year. So they probably generated some cash, and they did last year. We knew that 147 million, and that's what, and a bunch coming into this year, and so that's why they kind of bought and sold some. So again, not a big deal, but if you see some big changes here or big differences here, that's when you might be a little bit concerned. Not so much the year to year, okay, as the change within the year. If they purchased a lot of investments and didn't sell a bunch, they probably had a whole bunch of excess cash generated. Okay, then you come down, purchase of other non-current assets. Same thing, so it's not equipment, machinery, it's something else that's a fixed asset. It could be a trademark or something like that, an intangible thing that they got from somebody else or another company, say. That's just the total there. Okay, so total cash flow from investing, again, this is, for Ruger's case, like I said at the start, I don't see anything here that's really worth looking at, but look at it for your company, because there could be some significant things going on there. So we cruise down a little bit more, and we find that excuse me, so they also and these are important. Look at that, the cash dividends that they paid out in 2020 were 114 million, but that dropped in half for 2021, and they had a good year in 2021. I'm not sure why they dropped their dividend. Okay, so this is one of those things that does jump out at me on the cash flow. Why'd they drop their dividend payment almost in half? Maybe they wanted to hang on to cash to build inventory, those types of things. It's possible, but that one we got to take a look at. Okay, and we get down here, and really that's just the total of those things going on there. And then we get some totals down here. You guys should check too. I don't see on theirs. No, I don't see it here. Issuance or payment for common stock, and they've got zeros here. Okay, many of you, and I really want you to look for this because this can be really important. Okay, we'll find that there's numbers here, and if they're buying back stock, this would be a negative. What's that mean? Well, companies can go right out in the marketplace and buy back their own stock. And why do they do that? Well, oftentimes they have excess cash and they don't know what else to do with it. They don't have other places to invest it. They can't figure those things out. And that's not what they're paid to do. They're paid to make widgets, right? And so they'll just buy back their stock. So instead of 100 shares outstanding, they'll buy back 5 shares, and there's only 95 shares outstanding, right? In theory, that should make the value then of those 95 shares go up, right? Probably by 5%, because their ability to generate cash in the future doesn't change with them buying back stock, but they've limited the number of shares that are outstanding. And so there are some big companies that have had really aggressive stock buybacks. I'll mention a couple. Apple and Microsoft both have pretty aggressive, have had, for the last several years, pretty aggressive stock buyback. Now, they're huge companies, and so even though they might buy back billions of dollars, stock, it's kind of in some ways small potatoes considering the amount of shares that they have outstanding. But over time, again, it just reduces the shares outstanding. It should increase the value for those people that still retain those, right? Other than that, these are just some totals down here. So we get, again, what the total change in cash was. In this case, up. Total cash at the start of the period is 20 million, and total cash at the end of the period is 21 million. So all these things up here contributed to just a very small increase in the cash that they have on hand, which is kind of interesting, right? That's kind of it for taking a look at the cash flows. So look at that for yours, and some of those, again, that maybe don't show up in Ruger, but you want to look for in your own. You might find, if you have questions about some of those, if there's some big numbers up here, like in the provisions, or some big numbers in the deferred liabilities or deferred asset accounts, if you got questions about that, let me know, and we'll dig into those together and try to figure it out. So thanks, have a great weekend, and we'll be talking to you next week.